On May 8th, Michael Burry published a warning on his Substack. Here's what Burry actually wrote, what 1929 actually looked like mechanically, and which of those numbers are flashing red right now.
Somewhere in your town, there is a renter who has never bought a single share of stock, and a small crash on Wall Street is about to cost that person their job. That is not a guess. That is how the last three big market unwinds worked, and the fuel for the next one is sitting in a government file, right now at the highest level ever recorded. If you own a rental, run a shop, or just live in a zip code that depends on people having paychecks, this file is your problem, even though your name is nowhere on it. Here is the whole thing in plain English before any numbers arrive. A lot of the money buying stocks today is not real money. It is borrowed. People put down a little of their own cash and borrow the rest from their brokerage to buy more. It works like an interest-only mortgage on a house you are flipping. As long as the price goes up, you look like a genius. The second the price drops, the lender wants their money back that day, and you have to sell whatever you can fast at whatever price you can get. Now picture a whole market flipping houses with borrowed money at the same time. When prices turn, everybody has to sell at once, and the selling itself drives prices down further, which forces more selling. That is the trap. And the amount of borrowed money loaded into that trap right now has never been higher. You have probably had a clip shoved in your feed telling you that Michael Burry says it is 1929 again. Burry is the investor who bet against the housing market before the 2008 crash and made a fortune, the one played by Christian Bale in the movie. Here is the correction, because it matters. He did not say 1929. In his newsletter, which is the paid online publication where he now writes, since he shut down his fund, he compared today to the year 2000, the dot-com crash. He has money behind it too. At the end of June and again on July 2nd, he placed bets that a group of stocks will fall, including the chip maker Nvidia, the car maker Tesla, and a memory chip company called Micron. The 1929 label came from a different analyst named Nick Gurley, not from Burry. So if you have been repeating it, now you have it straight. But here is the part nobody put in your feed, and it is scarier than the label. Burry is watching stock prices. The real 1929 warning was never about prices. It was about the borrowing. And the borrowing is measured, published, and ignored. In 1929, the most famous economist in America, a Yale professor named Irving Fisher, borrowed heavily to buy stocks and told the country prices had reached what he called a permanently high plateau. Weeks later, the crash wiped him out completely. The house was sold from under him, and Yale rented it back to him so he had somewhere to live. The lesson is not that he was dumb. He was brilliant. The lesson is that borrowed money does not care how smart or how right you are. It only asks one question: can you pay today? So here is the number from the group that tracks it. Americans now owe $1.42 trillion borrowed against their stocks. That is a record, and it is the money reported by FINRA, which is the industry's own watchdog that collects these loan totals every month. In 1 month, it jumped more than 8%. Over the past year, it grew almost 54%. Back in the year before the 1929 crash, borrowing grew at a roughly similar pace, and that borrowing was a far larger share of a much smaller economy. Today's pile is the biggest slice of the American economy this kind of debt has ever been. There is a second number that is worse. As a group, these investors are now $991 billion in the hole, meaning they owe almost $1 trillion more than they are holding in cash. That cushion has never been this thin. Now walk it out to your street, because this is the whole point. When that borrowed money unwinds, the people who get the margin call are not spread evenly across the country. They are concentrated in the high-income professional workforce: the lawyers, the tech workers, the finance people, the doctors carrying leverage.
Hey, real quick, sorry to jump in, but the real estate crash bundle's on sale It shows you how the full real estate cycle works, where we are in it right now, what to watch, and what to move before the sequence actually completes. Check out the link below for the real estate crash bundle. Now let's get back to the video.
When their portfolios get sold out from under them, three things happen fast, and none of them stay on Wall Street. First, the spending stops. That crowd cuts back immediately, and the businesses that live off that spending feel it first. That is your restaurant tenant who suddenly cannot make rent, your salon, your contractor, your gym. When their customers vanish, your rental income and your storefront occupancy go with them. Second, the layoffs start. Companies that spent big during the boom cut staff when the market turns. A laid-off worker is a renter who stops paying, a mortgage that goes late, a house that gets listed into a falling market on your block. Third, and this is the slow one that hits everyone, the town's tax base shrinks. Local governments budgeted for today's paychecks and today's property values. When both fall, the money for road repair, for the fire department, for the schools your home value depends on, gets cut. You do not have to own a share of anything to eat all three. There is a piece of this that reaches even the workers who look safe. A chunk of that professional workforce is here on what are called H-1B visas, the work permits that tie a foreign professional's right to stay in the country to their job. Lose the job, and the law gives them about 60 days to find another or leave. In a broad layoff, they do not stay and job hunt for a year the way a citizen might. They exit the local economy entirely inside 2 months, and they take their rent, their car payment, and their grocery spending with them, all at once, out of your zip code. Whole apartment complexes near the big employers were built on the assumption that those tenants would always be there. There is also a debt bomb wired to the same paychecks. There is roughly $1.8 trillion in federal student loans in this country, and a large part of that is owed by exactly the high-earning professionals whose incomes are on the line here. Those loans are only good as long as the income behind them holds. Take away the jobs, and you're stacking a student loan default wave on top of a market unwind, both feeding the same downward pull at the same time. And it reaches the one building your whole community leans on when things go bad: the hospital. Hospitals built their budgets around insured, high-income patients, the ones with good coverage through good jobs. When that patient loses the job, the good insurance goes with it, and the hospital's revenue drops. Hospitals respond by cutting services and staff, and those cuts do not fall only on the people who lost jobs. They fall on the whole surrounding community that uses the same emergency room, the same maternity ward, the same clinics. Now, it is fair to ask whether this has to end in a crash. It does not have to, and there are real breaks today that did not exist in 1929. Back then, people could buy stock putting down as little as a dime on the dollar. Today, the rules require at least half. Bank deposits are insured now. Markets have circuit breakers that stop trading in a panic. Those are genuine protections. But one thing people assume is not true. Many expect the Federal Reserve, the nation's central bank that sets interest rates and is supposed to steady the economy, to ride in and cut rates the moment stocks wobble. Right now, that rescue is not on the table. The Fed has held rates steady all year, and the betting in the market points to rates going up before year end, not down. So do not plan your safety around cheap money showing up to catch the fall. It may not come. The honest read is that it is 1929's engine bolted into a car with better brakes. The brakes are real, but the engine, the borrowing, is running hotter than the brakes are strong. And the amount of forced selling fuel in the tank is the most there has ever been. The recovery question, the one you actually care about, has an uncomfortable answer. Even Irving Fisher was eventually proven right that stocks recover over the long run. It did not save him because he was too far in debt to survive the years in between. A market can come back and still take your tenant's job, your storefront, and your town's budget down for long enough to change your life on the way through. The people who came through the last one did not predict the day it turned. They watched the borrowing, and when it stopped climbing and started falling, they got out of the way. That is the tell worth watching. This borrowing number is published every month, and the next reading lands in the third week of this month. In 1929 and again in the year 2000, the warning was the same. The first monthly drop from a record high was the moment the whole thing began to come apart. Not the peak, the first step down. So watch that number the way the people who survived watched it. When the borrowing stops going up, the clock has started. And the first thing to move will not be a headline. It will be a job on your street. This is Economic Ninja, and we will be watching it for you. Economic Ninja is out.